Oil surged the most in 4 years as tanker traffic halted through the Strait of Hormuz amid escalating conflict in the Middle East, threatening supplies, of course. Here to talk about this and the markets is Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. It's good to have you join us. Thanks so much.
Thanks for having me.
So the spike in oil and energy prices in general that we're seeing today, how long do you think we'll see this continue, or do you foresee more volatility, I guess, in the future?
Well, I think it's the latter. You're going to see a tremendous amount of volatility and uncertainty. There's no telling how long this conflict can go for. This may go for a month or so. With that said, the real question mark is what will the impact be on inflation trends globally and as well domestically, and as well what will the impact be on global growth expectations? And we don't see at this point in time a massive drag on global growth for the global economy.
Why is that?
Well, you would have to see an additional spike in oil prices, and the fuel costs would have to stay at that level for a longer period of time than a month or so. So our expectations for global growth is around 3.75% to 4.25%. U.S. growth around 2.75%. This may have some shorter-term implications on potential inflation trends in the short run. But again, like I started the conversation, there is a big question mark based off of severity and duration.
Okay, based on that kind of idea of what the economy could look like, does that change your outlook at all on credit spreads?
Well, credit spreads historically are tight. That to us is really a canary in the coal mine when it comes to the speculative fervor within the credit system, as well as within the stock market or equity market. So as credit spreads widen out, that will create a seam of opportunity to buy into companies, at a discount. But at this point in time, credit spreads are still super tight. We would be mindful of that and still stay on the sidelines.
We've also been watching, obviously, the price of gold. It was up this morning, pairing gains at the moment. Is that something that you would expect amid all this really uncertainty that we're seeing unfolding over the weekend and into this week?
Yeah, that's a safe haven trade. A lot of short-term traders buy that as an inflation hedge, and as well as almost like an insurance policy. Gold has gone a bit higher. At the same time, you've seen the long end of the yield curve spike higher by 10 or 15, 12 basis points here in the United States. So these shorter term knee-jerk reactions are kind of playing out the way that I would expect. But this is we're only about 2 days into it, and like you mentioned, credit spreads as they widen out, then the financial system could become a little bit more volatile.
Okay, so we've got a stock hold and a stock drop. We'll go through them both. We'll start with your stock hold. What is it? It's IBM, I believe. And why is that your stock hold?
All right, so we like IBM. We own it in our rising dividend portfolio. There is a expectation of growth of between 5% and 6%. So we're not talking about a company that needs to have explosive growth on the upside to justify its valuation. We believe that there are 3 tailwinds that we think will continue over the next 3 to 5 years. One is their software side of their business, which is roughly about 40 to 45% of their revenues, will be growing, we believe, in double-digit territory. And it is and complements the AI infrastructure build-out overall. Second engine of growth, we believe to be on the mainframe side of the business. This long legacy business that was this low growth business, actually we think can have some get up and go and surprise investors over the long run as corporations have to battle the decision to go on-prem or off-prem or be hybrid with a hybrid cloud. We believe there will be many more corporations doing that hybrid cloud decision based off of cost, functionality, and security. And then third component of it, which is actually a drag on valuation at this point, we think will get revalued, is the consulting side of the business. US corporations and global corporations will need to hire outside consultants that will have a core competency in how to use artificial intelligence in their line of business to gain productivity. We think that these three divisions over the course of the next 3 to 5 years will be humming. So we see this as a growing, profitable, well-capitalized company with a rising dividend thematic.
On the flip side, stock drop. I'm not sure if you have a particular stock or just kind of a sector you think investors should be shying away from right now.
Yeah, like this is one of these things that I would duck from. So there's a tremendous amount of euphoria and excitement when it comes to data center build out. That could be on the neo cloud side or whatever have you, the terms that they want to use. And the reality is that these infrastructure spending cycles go in a cycle of boom to bust. And we're estimating that there will be roughly about $4 trillion in the next 5 to 6 years of data center build out. The reality, though, is that there has to be a return on invested capital. They're leveraging themselves to achieve these build outs in regard to their assets that they're buying, either it be chips from the various chip providers. They do have a finite life to them. This is very different than the internet build out of fiber optics. When they built out fiber optics, they put it into the ground. It had a 100-year shelf life. These data centers don't have that type of shelf life to generate the revenues that are needed. Now, when the cost of compute is elevated right now, we believe that will fall dramatically over time, as history has showed that through technology and the evolution of technology, that happens, and it's really a high probability.
Okay.
So we would avoid that build out.
Okay, Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Appreciate your time. Thank you.